afternoon. I'd like to begin by welcoming our guests to the Federal Reserve. The proposed rulemaking we're considering today is a further step toward putting in place the integrated and comprehensive regulatory capital framework known as Basel III that the Board has been developing for some time in consultation with our domestic and international colleagues. Critically, this framework would require banking organizations to hold more and higher quality capital. It would also finalize the market risk capital requirements, thus implementing what is known as Basel 2.5. To reduce compliance costs and minimize effects of higher capital on lending, the proposed rulemaking would phase in the new requirements over a period of time. Capital is important to banking organizations and the financial system because it acts as a financial cushion to absorb firm losses while reducing the incentive for firms to take excessive risks. With these proposed revisions to our capital rules, banking organizations' capital requirements should better reflect their risk profiles, leading to improved resilience of the U.S. banking system in times of stress and thus contributing to the overall health of the U.S. economy. So I welcome the staff as well, and I look forward to today's discussion of this important initiative. Let me turn the meeting over to Governor Tarullo.
Thank you, Mr. Chairman. While rigorous capital requirements are not a sufficient condition for a strong, resilient financial system, they're surely a necessary one. A bank with a strong capital position can absorb losses from unexpected sources, whether an external shock to the economy, the insolvency of important counterparties, or a failure of risk management within the firm. Strong capital buffers help ensure that losses are borne by shareholders of the bank, not by taxpayers, either directly through some form of bailout or indirectly through a major negative effect on the economy resulting from a bank's failure. Uncertainty about the capital positions of large financial firms was a major factor in the turmoil that beset the country in the fall of 2008. The subsequent increases in capital at our major banks, along with the information provided by the stress tests in 2009, were important factors in stabilizing the system. Pre-crisis capital requirements had been too low in general, had risk weights that were especially inadequate for certain securitized and other traded instruments, were too easily met through capital instruments lacking the loss absorption capacity of common equity, and were focused almost exclusively on firm-specific rather than economy-wide risk. The one final and three proposed rules before us this afternoon mark an important milestone on the road to a set of strong, complementary capital standards for banking organizations. We have already promulgated a rule for annual capital reviews of large bank holding companies, which are conducted against the backdrop of our annual stress tests. Last year, the three federal banking agencies adopted a rule to implement the so-called Collins Amendment of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which provides that banks using the Basel II advanced approach must also meet capital requirements as calculated using the standardized method applicable to all banks. As staff will shortly explain, the final rule before us today would address inadequacies in trading book capital requirements as agreed in the so-called Basel 2.5 revisions to the International Market Risk Capital Framework. The three proposed rules would increase both the quantity and quality of required capital, focusing squarely on common equity, as well as update both the standardized and advanced methods for calculating capital requirements. While approval of today's proposals will mark major progress on the way to overhauling capital requirements, it does not signal the end of that effort. Clearly, of course, we will need to finalize the three proposed rules. Next, once refinements of the Basel framework on capital surcharges have been completed, we will need a regulation to apply surcharges to U.S. institutions with the largest systemic footprints. Looking beyond these measures already in train, I hope that we and other regulators will also consider two ideas for further capital reforms. First, depending on the results of the fundamental review of the trading book currently underway in the Basel Committee, we may want to return to the market risk capital requirements at a later date. I, for one, am particularly interested in exploring possible standardized capital requirements for market risk as a backup for model-derived risk weights, just as we do now for credit risk. Second, we may want to consider changes in capital requirements to ensure that there would be adequate subordinated debt for similar liabilities on the balance sheets of the largest banking firms to help ensure they could be successfully resolved under Title II of Dodd-Frank through the conversion of debt to equity. The reason for the multiplicity of capital requirements, which also include a new leverage ratio, is that every individual capital measure has limitations and is subject to regulatory arbitrage. However, it is important to note that the full set of these requirements would be applicable only to the largest institutions. Smaller banks are not covered at all by the stress testing, capital review, and surcharge requirements, nor will they be subject to the new Basel III leverage ratio or countercyclical buffer, nor are they likely to be affected by most of what is in the market risk requirements or, of course, to the changes in the advanced approach's risk weights. For smaller banks, there will still be only two capital requirements, the traditional leverage ratio and the standardized risk weight approach that is being updated in one of today's proposed rules. All four of the rules before us today are the product of joint rulemaking with the FDIC and OCC. Most of the content of those rules was also the subject of the Basel 2.5 and Basel III international capital frameworks. I should note that board staff provided significant leadership in the Basel discussions over the last several years. They also spent many hours drafting the rules before us today as interagency negotiations eventually yielded agreement or compromise on individual points. Annalee Hugo, in particular, has been indefatigable in bringing this work to a conclusion. I mention this not just to give kudos to Annalee, to Mike Gibson, Nora Barger, Pat Parkinson, and others, deserved as they are, but also to underscore the fact that these are consensus rules, the product of extended negotiating and collective drafting efforts. Left to my own devices, I would not have written everything the way it is in these rules. Indeed, I doubt that anyone, staff or principal, at any of the three banking agencies would have done so. We will, of course, have ample opportunity to consider the comments on the proposed rules with respect to items that the agencies have added to international standards and to consider alternatives. All of that being said, I want to reiterate unqualifiedly that the package as a whole will be a major contribution to achieving a strong financial system. And with that, Mr. Chairman, I'll turn to Governor Duke.
Thank you. I'm going to confine my opening remarks to the aspects of the rule that seem most applicable to community banks. I want to begin by declaring my support for strong levels of high-quality capital in banks of all sizes. The recent experience in the financial crisis demonstrated that the level and quality of a bank's capital was a primary factor in its ability to withstand adverse conditions and continue lending to households and businesses. This is just as true for small banks as it is for large ones. Not only will stronger capital add resilience to individual institutions, but all banks, including community banks, also benefit from the strengthening of the entire financial system. Aggregate additional capital held by all banks should reduce volatility in financial markets and collateral valuations. Furthermore, under Dodd-Frank and in this proposal, larger banks using the advanced approach to determine their required capital will not be able to reduce their required capital to levels lower than that required of community banks. This would remove the concern expressed by community banks about Basel II that larger banks could gain a competitive pricing advantage through lower capital requirements for some banks. I would especially like to applaud the staff for an exemplary effort that not only incorporates the provisions of Dodd-Frank and Basel III, but that also restructures the capital rules into a harmonized, integrated regulatory framework. The product of this effort runs hundreds of pages, so I want to thank and commend the staff for the breakthrough practice of including a shorter summary for the provisions that apply to community banks. The summaries, which are included as addenda to the two proposals that affect community banks, reduce this much required reading to 34 pages. And I would note that each of the summaries contains references back to the sections of the full rule for those who want to drill down further into the details. I think this is an especially valuable innovation for regulatory proposals. It's very important that we hear comments from banks of all sizes. Yet I know from personal experience how daunting it is to wade through hundreds of pages of sometimes complicated provisions to try to understand which provisions are applicable to a small community bank. Perhaps by offering the summaries, we will receive more specific comments from community banks and comments from banks that otherwise would be deterred by the sheer volume of the proposals. I really like the summaries, and I think they might be helpful beyond their usefulness for community banks, but since they're included as an addendum, they don't appear until late in the documents. I confess that I don't know the issues you face in the legal framework, but I hope we'll continue to use summaries in future rulemakings and find a way to alert readers very early in the document about the existence and location of the summaries. And finally, I'd like to stress the importance of understanding the trade-offs between the costs of significant changes to bank accounting and reporting systems and the benefits against the benefits of more granular calibration of risk. Some parts of the proposal seem to be likely to require significant reprogramming by smaller banks. Before we impose such burdens, it's important that we understand the costs involved with each data element and weigh it against the expected improvement to the resiliency of the financial system. So I'll be especially interested in commentary on the operational burdens that these rules might impose. And now I'll turn it over to Mike Gibson.
Thank you. In our staff presentation today, I will begin with a brief discussion of how the capital reforms we are discussing today fit into the larger package of reforms that are underway in the wake of the financial crisis. Mike Kiley will discuss the macroeconomic impact of higher capital requirements. Annalee Huco will describe the proposed and final rules in more detail. Stronger capital standards are an important part of the regulatory reform program that is being put in place in response to the financial crisis. In addition to the package of rules we are discussing today, there are other complementary efforts underway to strengthen capital, particularly at the largest financial firms. The Federal Reserve has adopted a capital plan rule in which the largest banking organizations must annually stress test their capital positions against an adverse economic scenario. The capital plan rule is the basis of the Federal Reserve's enhanced prudential standards proposed under Section 165 of Dodd-Frank. We intend to supplement that proposal with a subsequent proposal to implement a risk-based capital surcharge based on the Basel Committee's surcharge for globally systemic banking organizations. Outside of capital, reforms are underway to make large banking organizations more resolvable. In the United States, large banking organizations will soon be submitting resolution plans or living wills to the FDIC and Federal Reserve to help ensure that they can be resolved without causing a systemic risk. If a systemically important financial firm does get into severe financial difficulty and its failure would pose a threat to financial stability, orderly liquidation authority under Title II of the Dodd-Frank Act can now be used by the FDIC to resolve such a firm. In addition, the Federal Reserve has strengthened its supervision of the largest bank holding companies through the creation of the LISC, the Large Institution Supervision Coordinating Committee. And important reforms are underway to reduce the potential for systemic risk from OTC derivatives, including an emphasis on central clearing of derivatives. All of these elements of the reform program taken together are intended to increase the resiliency of the financial sector and ensure that the banking system can support a return to strong and stable growth for the U.S. economy. And I'll now turn it over to Mike Kiley.
Thank you. In my remarks, I will summarize the staff's assessment of the benefits and potential costs to the macroeconomy that may stem from higher capital requirements for the banking sector. In order to assess the effects on the macroeconomy of higher capital requirements, staff investigated a range of possible channels and impacts, used a variety of approaches, and consulted with experts from academia and from the private sector. This analysis involved consultations with staff from central banks and regulators around the world, which were coordinated by the Basel Committee. Much of this work was performed over the course of 2010 as the initial Basel proposals were being formed. In macroeconomic terms, the main benefit of stronger capital requirements stem from a lowering in the probability of a banking crisis and the associated output losses. In addition, higher capital buffers are likely to reduce the amplitude of fluctuations in economic activity outside crisis periods. A variety of approaches were used to examine these possible effects. In general, these analyses found significant economic benefits from higher capital requirements for two reasons. First, historical experience suggests that the cumulative loss in economic activity from a banking crisis is sizable. And second, experience also demonstrates that higher levels of capital reduce the probability of a crisis. Analyses were also careful to consider the macroeconomic costs that could accompany higher capital requirements. Using a range of models and approaches, staff considered the possible impact of higher capital requirements on banks' cost of funds, as well as banking institutions' reactions to such changes. Overall, our analyses considered cases in which the impact of higher capital on bank costs were significant and could potentially affect their willingness to lend. Nonetheless, such long-run adverse consequences were estimated to be modest relative to the benefits. Finally, our assessment considered the impact of higher capital requirements over the transition period that is part of the proposed standards. Using a range of macroeconomic models, the possible short-run costs in terms of economic activity that could stem from higher borrowing costs charged by banks or decreased willingness to lend were estimated to be moderate. Indeed, the potential adverse impacts on economic growth estimated by most of our approaches on a per-year basis were low, quite low, relative to the year-to-year fluctuations in growth that typically characterize economic recoveries. The modest drag on economic growth in the short run, estimated in our analysis, owed partly to the transition period, which ensures that banking organizations have sufficient time to adjust to the new standards in a forward-looking manner, thereby facilitating continued access to credit for borrowers as these important new standards are implemented. That concludes my prepared remarks. Annalee will follow up with more details.
Thank you. The final rule and proposals before the board today are the product of a tremendous team effort across divisions here at the board, and they represent the culmination of a major policy initiative to address weaknesses in the regulatory capital framework highlighted by the financial crisis. I will provide an overview of the rulemakings this afternoon, and my colleagues, including Connie Horsley, Tom Boemio, April Snyder, and Ben McDonough, will help answer questions about the details of the rulemakings. As several governors have mentioned, in considering how to implement the Basel agreements in the United States, staff considered which aspects of the agreements were most appropriate for which banking organizations. Some parts of the proposal before you today would apply to all banking organizations, whereas others would apply to a subset based on their size, foreign exposure, or trading activities. In particular, a number of aspects of Basel 2.5 and Basel III that would significantly raise capital requirements for trading and derivatives activities would apply only to a small number of banking organizations subject to either the market risk rule or the Basel II advanced approaches rule, less than 35 bank holding companies in all. And for internationally active banking organizations, the proposals combined with the final market risk rule would fully implement the Basel 2.5 and Basel III agreements to the extent permissible in the United States. Today's proposals also reflect a domestic response to weaknesses revealed by the financial crisis, especially insufficient risk sensitivity regarding real estate-related exposures and statutory requirements of the Dodd-Frank Act. Taken together, staff believes that the proposals would result in capital requirements that better reflect banking organizations' risk profiles and enhance their ability to continue functioning as financial intermediaries, including during periods of financial stress. The agency's capital rules have been created and updated in a somewhat piecemeal fashion over the last 2 decades. Given the scope of changes being proposed, the agencies took the opportunity to integrate the various capital rules into a comprehensive framework that removes inconsistencies that exist across the agency's current capital standards. And this complete restatement of the capital rules is a key reason for the length of the proposals before you today. There's a lot of repetition of what we're keeping as well as introduction of new material. So the agencies have taken several steps to make the proposed comprehensive framework more digestible for commenters. First, we are proposing it in 3 separate NPRs to help make clear which proposals apply to which banking organizations and to help interested parties focus their comments on particular areas of interest. The first 2 NPRs apply to all banking organizations, including state member banks, bank holding companies not subject to the board's small bank holding company policy statement, and consolidated savings and loan holding companies. In contrast, the 3rd NPR applies only to banking organizations subject to the market risk capital rule or the Basel II advanced approaches rule. In addition, as Governor Duke mentioned, The first two NPRs contain addenda to the preamble that highlight the differences between the current capital rules and the proposed framework that are most relevant for community banking organizations. Turning to the substance of the proposals, the first NPR would raise the quantity and quality of regulatory capital. Consistent with Basel III, it would establish a new common equity Tier 1 capital requirement of 4.5% of risk-weighted assets. It would raise the Tier 1 capital requirement from 4% to 6% of risk-weighted assets, and would leave the minimum total capital ratio requirement unchanged at 8%. On top of these minimums, the proposal would also establish a capital conservation buffer comprised of common equity Tier 1 capital equal to 2.5% of risk-weighted assets. The buffer is designed to provide incentives for banking organizations to hold sufficient capital to withstand a severe systemic stress event and still remain above the minimum capital levels. The proposal emphasizes common equity Tier 1 capital, which is the highest quality, most loss-absorbing type of capital, and it's the measure that the Federal Reserve has been using in its Comprehensive Capital Analysis and Review, or CCAR, as well as the Capital Plan Rule. Also consistent with Basel III, the proposal introduces more strict criteria for allowing instruments to be included in regulatory capital, as well as more stringent deductions from capital. Most capital instruments traditionally issued by depository institutions already meet these criteria. So the main impact would be that cumulative preferred securities and trust preferred securities would no longer qualify as capital for bank holding companies with transition provisions. The approximately 20 bank holding companies and their subsidiary depository institutions that are subject to the advanced approaches rule would be subject to an additional capital requirement, a supplementary leverage ratio requirement of 3%. This requirement is consistent with the leverage ratio developed by the Basel Committee as part of the Basel III package. And the most important difference from our current leverage ratio is that it includes off-balance sheet exposures in its measure of exposure. So turning to impact, most community banks would meet the new minimum capital requirements plus the capital conservation buffer if they were imposed in full today. In looking at the impact of the entire proposal on bank holding companies under $10 billion that meet our current regulatory capital requirements, our pro forma analysis indicates that more than 90% would meet the 4.5% minimum common equity Tier 1 ratio today, and more than 80% would meet the 7% common equity Tier 1 ratio plus buffer level. The aggregate shortfall for these bank holding companies not meeting the 7% minimum plus buffer would be about $3.6 billion. As Mike mentioned, the proposals contain an extended transition period that would allow banking organizations that don't meet the minimums or the buffers today to accrete capital through the retention of earnings. In particular, the buffer is proposed to be phased in from 2016 until 2019. During the CCAR process in 2012, supervisors assessed whether each of the largest 19 bank holding companies was making steady progress to meet the Basel regulatory capital standards, including Basel II, 2.5, and 3. The assessments indicated that these firms generally are on the path to meet the proposed capital requirements over the proposed transition period, with an aggregate Tier 1 common shortfall of approximately $50 billion. The new minimum capital requirements under the proposals would have additional implications for large banking organizations subject to the Capital Plan Rule or to the Basel II Advanced Approaches Rule. Governors Tarullo and Duke have already mentioned that they would serve as a floor for banking organizations subject to the advanced approaches. And in addition, the higher minimum capital requirements would flow through to the Capital Plan Rule, which requires bank holding companies with $50 billion or more in consolidated assets to demonstrate that they can maintain capital above their minimum capital requirements over 9 quarters of stress conditions. So those minimums would be raised. Turning now to the denominator of the risk-based capital ratios, the proposal contains a standardized approach for calculating risk-weighted assets that is similar to the approach in our current capital rules, but contains some more risk-sensitive elements and options. For most banking organizations, the most important changes are in the treatment of residential mortgages and certain land development loans, and reflect lessons learned from the financial crisis about the risk of these types of exposures. The proposed approach for residential mortgages is more risk-sensitive and granular than the current approach, which which assigns almost all first lien mortgages a preferential 50% risk weight. Instead, under the proposed approach, residential mortgages would be divided into two categories based on whether they meet certain prudential underwriting and product characteristics. Mortgages in both categories would be assigned a risk weight based on their loan-to-value ratio at time of origination. And the risk weights would range between 35 and 200%. Land acquisition, construction, and development loans have significantly higher delinquency and charge-off rates than other commercial real estate loans and have contributed significantly to a number of recent bank failures. Thus, the proposal would increase the risk weight on most acquisition, construction, and development loans to 150%. Turning to the market risk rule, it would significantly strengthen capital requirements for the trading activities of approximately 25 bank holding companies, capturing risk beyond those captured in the current rule and reducing capital arbitrage opportunities. The calibration of the final market risk rule's capital requirements would reflect appropriate periods of market distress and better reflect the tail risk of positions. And in addition, the final rule would significantly increase capital requirements for structured credit products whose risks were previously not adequately captured. In addition to this rather granular microprudential risk sensitivity, the proposals and the final rule contain a number of macroprudential elements designed to mitigate risk and cyclicality in the financial system as a whole, as well as promote the safety and soundness of individual banking organizations. For example, in addition to the capital conservation buffer, all banking organizations would be subject to capital requirements that are calibrated to reinforce the migration of derivative transactions to central counterparties. They would also be subject to capital deductions designed to incent reduced interconnectedness amongst financial firms. The advanced approaches rule would also layer on a number of macroprudential features to which smaller banking organizations would not be subject. These include a countercyclical capital buffer that allows regulators to increase the capital conservation buffer and thus loss absorption capacity in the system in times of excessive credit growth. Counterparty credit risk capital requirements on derivatives that reflect the heightened systemic risk associated with the interconnectedness of large derivatives dealers, and increased capital requirements for credit exposures to large financial firms. The market risk rule also contains macroprudential elements designed to reduce procyclicality and mitigate other weaknesses associated with VaR-based measures. So the proposal and the final rule implement a number of requirements of the Dodd-Frank Act. For example, the proposal incorporates consolidated capital requirements for savings and loan holding companies. It establishes generally applicable depository institution capital requirements that serve as a floor for other capital requirements, and it narrows the current definition of capital for bank holding companies. Consistent with Section 939A of the Dodd-Frank Act, the proposal and the final rule do not include any references to credit ratings. And the greatest impact of this provision is on the treatment of securitization exposures. Last December, the agencies proposed alternative measures of creditworthiness in the context of the market risk rule. The agencies have modified the proposed approaches based on comments received, and aspects of the modified approaches are in today's standardized and advanced NPRs and in the final market risk rule. Finalizing the market risk rule would significantly strengthen capital requirements for trading activities and would be a significant step forward in addressing weaknesses in our capital rules highlighted by the financial crisis. The proposed comprehensive capital framework would build on that progress, increasing the quality and quantity of capital held by all banking organizations and targeting specific risk areas where the current capital rules have proven insufficient. Together, the rulemakings before the board today would better position U.S. banking organizations to continue to function as financial intermediaries during times of stress and enhance the resiliency of the system as a whole. So that concludes my prepared remarks, and my colleagues and I would be pleased to answer your questions.
Thank you very much. This is the culmination of a very long process that's involved international negotiations as well as coordination with other agencies here in the United States. And I would also like to extend my appreciation to the staff for their persistence, as well as your good work. Could you explain a little better, you were talking about the shortfalls that banks currently have relative to these capital requirements. Over the period in which these requirements are phased in, would you expect to see banks having to issue new equity, or can they meet these requirements through earnings? What is our general sense of what they have to raise?
Our general sense is that they could meet it through retained earnings, both on the small bank side and the large bank side. Banks have done significant capital raises already, and that's positioned them well to meet the requirements as they phase in.
Thank you. Could you talk a little bit about, you didn't mention the phrase prompt corrective action in your presentation. Could you talk a little bit about how that is imported, and how that works in the context of this proposal?
Sure, I'll actually turn it over to my legal colleagues for that.
So the prompt corrective action framework would be revised to include the new minimum requirements that would be established by the proposals. It would not include the capital conservation buffer, as that buffer has a different intention, which is to encourage banking organizations to maintain a cushion above their minimum requirements in order to absorb losses under times of stress. And that is accomplished by placing increasingly stringent limits on capital distributions and bonus payments as the buffer starts to fall and get closer to the minimum ratios. Under the PCA framework, if a banking organization falls below the minimum ratios, as is the case today, then other supervisory actions would automatically take effect. So the two frameworks have different purposes.
Thank you. This is a kind of a technical question, but this has to do with the unrealized gains and losses on available for sale debt securities, which now under this proposal are going to feed through into Tier 1 common equity. I understand the benefits of having a sort of mark-to-market approach to capital, but on the other hand, this will increase volatility in measured capital, perhaps make it more difficult to plan. Could you discuss the benefits and costs of making this change?
Sure. I was going to talk about that.
Certainly. A guiding principle throughout this discussion has been loss absorbency of capital. When we looked at some of the volatility that existed in the current capital, some of that was constrained because we reversed certain types of losses, the ones you've referenced, in particular the unrealized holding losses on available sale equity securities. At the same time, we realized during the crisis, if we were to have a liquidity or other problem, those securities were properly valued, could not be, in essence, increased in value by the reversal of these losses. Excuse me. So during our deliberations, we weighed whether or not that was a benefit longer term. We looked at the individual impact. There was some volatility over a period of time. We ran the numbers as recently as this past March, our most recent call report data, and we found that in those cases we looked at, the introduction of unrealized holding gains and losses to the capital regime was actually additive. It increased the amount of capital that the firms had available to meet the requirements. So in times of an economic downturn or changes in interest rate, that may be reversed, but what we did factor in is over a period of time whether or not those costs could be absorbed. And that's in large part because we thought that modeling that would be of importance. We did look at a period of time. In the most recent period, again, it looked to be very additive. In this case, gains were being incorporated rather than just losses. That was true for particularly banks under 10 billion, and we also looked at banks over 10 billion, and it was slightly negative, only about 10 basis points if I think of our most recent run. So the costs were measured in current terms of the reduction in capital, and then we looked at a period of time whether or not losses should be added back, and we couldn't come up with a good justification for sustaining that model.
Thank you. Vice Chair.
Thank you. I wonder if you could say a little bit about the countercyclical buffer and what kind of thinking went into the determination of its size and how you contemplate its being used. What would be the decision-making process, for example, that would bring this into play?
Sure. So the countercyclical buffer is designed to be a macro potential tool available to regulators and policymakers. It's designed so that when it's turned on, it increases loss absorption capacity in the system. It may also act something as a brake to further lending by increasing not exactly capital requirements, but effectively putting penalties on banks that don't meet the higher buffer. The proposal is not very specific about exactly how it would work. It outlines the mechanics that we would expect it to be a joint interagency decision, and it outlines some of the factors that we expect might be considered by the policymakers. But I think that's an area that we still need to do some thinking about how the exact decision would be made.
And Annalee, you might want to tell the Vice Chair the range of banks to which the countercyclical buffer.
Oh, yes. So we did make the decision to apply the countercyclical buffer only to the largest banking organizations, the advanced approaches banking organizations. There were a couple reasons for that. One is the complexity of having to manage to a potentially moving buffer for smaller banking organizations who don't have much access to capital markets. That didn't seem particularly reasonable. And also, the biggest banks are the most interconnected, and so we got the biggest bang for the buck, say, by imposing the buffer on them.
Thanks, that makes a lot of sense. Now, I know one of the challenges that you faced in writing these rules was that Dodd-Frank prohibited the use of credit ratings. And I wonder if you could just talk a little bit about the alternatives you've used and whether or not you feel satisfied that you have found workable alternatives.
I'll actually turn that over to Tom to address.
So during the proposal last December, when we actually made these proposals in the market risk rule, we came up with a number of alternatives. We had been working on this for a number of months with the other agencies, and it was a bit challenging. We have developed for sovereigns and basically foreign sovereigns and for public sector entities in sovereign countries and for foreign banks, the use of what we call country risk classifications, which is somewhat different from the current approach where we look at OECD. It's a little bit more risk sensitive in that it gives ratings to a broader group of countries. It's not as risk sensitive necessarily as we would like, and clearly we're not going to look at individual banks and be able to assess their credit quality when we look at the rating of a country, because we would have a rating for the country and then we'd step up the capital charge for the banks one step higher in the risk weight. With respect to corporate exposures in the trading book, we have drawn a line that we say investment grade, but it's not relying on a rating, but it's looking at a number of different aspects. A bank would have to look at a number of different aspects and determine whether or not the counterparty is able to pay its bills, whether it's able to pay the obligation that is extended. And this is similar to the definition that the OCC is going to be finalizing soon with respect to the suitability requirements for purchasing assets at national banks, to which we're also subject to. With respect to securitization, as Annalee mentioned earlier, that was a little bit trickier. And we developed what we call the simplified supervisory formula, which is the supervisory formula is something that we currently have in Basel II, which we have in our advanced approaches rule. But this is a simpler approach, and we're going to import that from the market risk rule, and we're proposing that in the credit rating rules as well, so that it can be used by smaller institutions. We tied it to the capital requirements on the underlying securitized assets. So for residential mortgages, we would look at the underlying exposures, and whatever that capital charge is for that pool, that'll be our starting point. And then we charge lower and lower capital amounts as we get more and more senior in the security tranching. So we are relatively happy with that. It's not quite as risk sensitive as possibly where we were, but as we know, ratings blew up. And so we're much more comfortable with where we are and comes up with higher amounts of capital.
Thank you very much.
Governor Duke.
Thank you. Annalee, I appreciate your estimate of the number of banks that would meet the higher capital requirements today. It seems to me in coming up with that estimate, though, you had to make some assumptions for data that just doesn't exist today. So I wonder if you could identify the data that might be particularly difficult for smaller banks to locate and to track that doesn't exist today.
Sure. So with respect to the numerator, we had to make some assumptions with respect to how we would allocate deferred tax assets that would be deducted under the proposal versus those that would be subject to the capital limitations. In addition, we also had to make an assumption, and the small banks are going to have to be able to track the investments in unconsolidated financial subsidiaries that they may have some investment in, so that they can also be subject to the capital limitations as well. With respect to minority interest, which tends to be in Tier 1 capital today, the banks are going to have to be able to track which part of minority interest would be allocable to common equity and which part would be allocable to additional Tier 1 capital. With respect to the denominator, we had to make a number of assumptions. In particular, we had to make an estimate of high volatility commercial real estate, and we had a line item on the call report where we could pull this information, but because of the definition of HVCRE in the proposal, which is more of a subset of what we currently collect on the call, we're going to have to probably collect some additional information, or the banks will have to track a subset of the current HVCRE, the construction loans. We also, with respect to residential mortgages, institutions will have to look at and track the loan-to-value ratios on their particular mortgage products, and then we're going to have to look at the type of mortgages. Is it a negative M? Is it an IO? Is it a typical fixed rate amortizing loan? So that's going to be some additional requirements for them there. With securitization, we're going to be changing the way we look at securitizations for purposes of capital, and as a result, the banks are going to have a better understanding of the structure of the position that they hold and the structure of the securitization in which this tranche is a part of. They're also going to have to look more at the underlying assets depending upon the risk weighting option that they take for securitizations to get a better sense of the performance of the underlying portfolios. In addition, as you've mentioned earlier in your opening remarks, there's going to be an effect on these institutions with respect to their systems. They're going to have to change their systems to collect the information that they're now going to need to risk weight their exposures under the proposed standardized approach. Now, many of the smaller institutions use vendors, and we fully expect to be working with the vendors as we change the call reports and as we move forward so that they can actually report accurately and actually ask for the appropriate data so that it can be risk weighted. So that pretty much wraps it up. We do believe that there's ample time for us to make these changes because the standardized approach actually comes into play in 2015, though people have the ability to early adopt if they like, but there is a little bit of a transition there as well.
Thank you. And just one other question, and I guess this one goes to you, Mike. I know that you've studied the expected overall effect of higher capital, but I wonder if you've studied the effect of the granular risk rating on mortgages, and particularly the risk weighting on HELOCs and home equity lending, and that impact both on housing as well as consumer lending and small business lending, which relies quite a bit on home equity.
So in our macro assessment, we didn't go into that degree of detail. We would look at how the broad shifts in required capital might affect banks' cost of funds and their willingness to lend. Staff certainly have been thinking about how different requirements might affect different aspects of lending, and obviously it is the case that mortgage credit is one of those areas currently that's where availability is tough for many households, but that degree of detail didn't figure into our macro assessment, importantly.
Thank you.
Tarullo?
I don't have any questions.
Governor Raskin?
Thank you, Mr. Chairman. I do have a question, and it has a bit of a wind-up here. I want to start by saying that the three proposed rulemakings before us today, I think, do represent significant progress towards addressing regulatory shortcomings that did become apparent during the recent financial crisis. Together, the texts of these proposed rulemakings underscore the importance of capital as a regulatory mechanism for absorbing the inevitable losses that financial institutions experience. I don't want to detract in any way from this good work by noting that from a regulatory and supervisory perspective, we cannot declare with these proposed rules mission accomplished. While the imposition of these capital rules and buffers are an important and necessary step towards strengthening the regulatory framework that large, complex banks operate within, they are not sufficient. In particular, these proposed capital rules are designed to focus on risk that is created by particular types of assets. If risk is developing outside these assets, for example, operational risks, reputational risks, or unaccounted for market risks, then the proposed capital rules should not be understood as having limited or constrained or controlled in any way these particular risks. In these cases, the overall sufficiency of the capital cushion must be relied upon to cover the risk that may be developing outside these asset classes. In short, the proposed capital rules provide a guide, a roadmap, so to speak, about certain parts of the balance sheet where risk may be lurking. But this is an imperfect guide because, as we all know, risk can develop and lurk in spaces that no one outside the bank, or sometimes even inside the bank, sees or can expect. In the run-up to the financial crisis, mortgage-related assets were weighted the same at low risk, and yet the losses that emerged from them were significantly destabilizing. Fraud risk is also almost impossible to detect, and risk-based capital rules should not be understood as being able to address the various massive fraud-related trading scandals that have rocked various financial institutions. In other words, capital requirements do not compensate for good governance and appropriate risk management by the institution. In addition to strong capital requirements, there is continuing need for exacting risk management controls and appropriate supervision of those controls. From this perspective, I continue to look forward to how the Federal Reserve System's regulatory and supervisory and examination staffs elaborate upon and build out their expectations for the internal governance and risk management controls that our country's largest and most complex institutions are expected to design and implement to capture the risks that develop outside the confines of formal capital rules. The need for supervision is all the more critical given that full compliance with most aspects of the rules won't be required until January 1st, 2019, which is more than 6 years from now. So let me turn to a second dimension that strikes me is a currently unavoidable deficiency in these proposed rules. In particular, I note that under the proposed rules, we are permitting large complex banks to rely on their internal models to ensure proper liquidity. We are proposing placing additional prudential requirements on these internal models. And these revisions, as I understand them, include requiring banks to take into account stressful conditions when modeling market risk capital requirements. I applaud the intent of the staff to address some of the shortcomings inherent in a reliance on the internal models of banks, but I do remain skeptical. I think we should proceed with such a reliance cautiously, or in other words, trust but verify. As a supervisory matter, I would like to see our examiners make sure that these internal risk models are keeping pace with the complexity that certain business lines or trades are presenting. If the internal risk models fall short, then the activities must be flatly and outright prohibited. End of story. My sense, by the way, is that our large and complex financial institutions have struggled with their ability to keep their internal risk models closely approximating and mirroring the risks that these institutions are embracing. Instead, we need assurances that the internal risk models are being updated regularly by the institution's chief risk officer and then examined regularly by the institution's examiners. To do this exercise correctly, the institution needs to assure that revenues and the risks generated by these revenues in various business lines are transparent so that stakeholders can provide input necessary to revise the internal risk models and assure their credibility. So this is now the question. Here it is. Do we currently feel comfortable, from a supervisory perspective, permitting banks to rely on their internal models for capital purposes, and to what extent will the proposed enhancements to these internal models address or not address our perception of any shortcomings in the bank's modeling processes?
So in the supervisory process already, since the introduction of modeled capital requirements for market risk, we have insisted on reviewing and approving internal risk models before the bank is allowed to use them for regulatory capital purposes. So in the past, it's already our current practice to do that, and we expect that we will continue to do that in the future. It's challenging. We can't detect every nuance of everything through our examination process, but we devote significant resources to it, and it is a high priority. One aspect of the current proposal is that, as Annalee mentioned, the capital requirements for trading activities are being increased substantially. I think our estimate is around 3 times what they were pre-crisis by, for example, the institution of the stressed VAR requirement, which requires the value at risk model be run under stressed market conditions. So that partially moves things in the direction that we think is the right direction. Whether it's completely sufficient is certainly something that we continue to work on. And as Governor Tarullo mentioned, we have a process underway within the Basel Committee, a fundamental review of the trading book, capital requirements, which is asking a lot of these questions about our reliance on models, and in particular, are there simpler backstop approaches that we could use to give us more comfort that the models are not leading us astray? So we share the concern. The proposal moves us in the right direction, and it's definitely going to continue to be a supervisory focus.
Thank you.
Governor Stein?
Okay, thanks very much. Annalee, you mentioned that one of the important components of this is to use capital to create incentives for over-the-counter derivatives to migrate to centralized clearing as opposed to remaining over-the-counter, I suppose. Can you just elaborate a little bit on the precise mechanisms by which that's going to work?
I'll actually turn that over to April.
So under the proposals consistent with the Basel standards, cleared transactions would get a lower risk weight than other transactions if they were made through a qualifying central counterparty. And under the proposal, the qualifying central counterparty has to meet certain standards, and this reflects the intention of the Basel standard setters that lower risk weights should only be applied to cleared transactions with parties that meet prudent risk management and governance standards. So the proposed definition of qualified central counterparty recognizes that many rules related to central counterparties that are either proposed or soon to be finalized in the U.S. would already encompass some of these standards. And U.S. entities that already comply with these standards should meet the definition of qualified central counterparty. And foreign central counterparties that are regulated and supervised in a similar manner would also likely be considered a qualified central counterparty.
Thanks.
Governor Powell? Thank you. I know that we all share a concern that, while we need to implement better and higher capital requirements on all of our financial institutions, that it be done in a way that minimizes effects on economic activity. And I think a big part of the answer of why we all believe that these rules comply with that desire is that the long transition periods are quite significant. So the question I have is, do you have any concerns that out in the field, banking organizations are going to be pressured to comply earlier than the transition requirements would suggest?
So that was a concern when the international Basel proposal was announced, and what we have seen in practice is that banking organizations were not immediately held to the higher standards. They are continuing to raise capital as we would expect, but there was not an immediate upfronting. And as I mentioned, for the smaller institutions, the capital gap is not very big, the aggregate gaps. So again, we think that they could beat it through retaining earnings and not be pressured to shorten the transition period in effect.
Thank you.
I would also add that that was an important consideration, but not the most important consideration in affecting the macroeconomic costs. So when we looked in our models at a faster transition period, it did as you expected, that if banks felt the pressure to pull things forward, we would estimate a larger impact. But the impacts were still quite modest relative to the types of benefits we expect to accrue.
Good to hear. Another question on just following up on the securities that were available for sale. One also hears, in addition to the volatility point that was made by the chairman, one also hears about a competitiveness point that this is going to affect American banks more than non-American banks. How do you think about that?
We monitor both what happens domestically in terms of accounting standards as well as what goes on internationally. This point had been raised early in our process. Both the U.S. Financial Accounting Standards Board and the International Accounting Standards Boards are aware of the difference. And last month, during their normal deliberations, the two boards agreed to implement an approach where available for sale securities that are classified in the U.S. would be likely classified in the same way abroad. So we saw that as an indication of this leveling of the playing field on this one point. What we remain vigilant in is to make sure that both boards do reach a converged solution for financial instruments that results in comparable accounting treatment. Since both the U.S. and our U.S. proposed rules today and the Basel Committee's framework flow through unrealized gains and losses to Tier 1 and common equity capital ratios, we'd anticipate that simply by the actions taken by the ISB to make their rules consistent with the U.S. rules, they would in fact flow through to all the regimes subject to Basel III. So we think that problem has been addressed.
That's great, thank you. And then finally, I would think, and I gather from reading the rules and the summaries, by which let me also express my appreciation for them, echoing Governor Duke, but that taking the business of taking references to credit ratings out of the rules has to have been one of the hardest things that you did, and I compliment you on it. When you talking about the use of CRCs for sovereign debt and financial institutions and other government entities, you talk in there about you evaluated using market-based measures instead, decided not to do it because more work was needed. Is that something that really is ongoing and could possibly come into play over time, or not?
Well, we had gotten some comments when we put the proposal out in December, and a lot of industry participants were also somewhat concerned. We're concerned about the liquidity of the markets, whether someone could game the markets if we did use some of the market-based measures. We've reproposed it again in the Basel III package, and we'll get additional comments on it. We have looked at it. It's not, and I think that we'll continue to look at it, but I don't think it's going to be the highest priority.
Thank you very much. I'm now going to go around the table and ask each governor to state their position. After we do that, we will take two votes. The first vote is for the notice of proposed rulemakings, the three elements that were described by Anna Lee, and the second vote will be for the final rule on the market risk rule. Vice Chair.
I support the proposal to put out for comment the three notices of proposed rulemaking to revise and enhance the board's capital requirements, and I also support finalizing the market risk capital rule. I consider the publication of the proposed rule on regulatory capital standards a major accomplishment. I want to congratulate the staff and my colleagues for the excellent work that they've done. The crisis showed the need for robust capital requirements to improve the safety and soundness of the financial system, and these rules do take a major step to significantly improve both the quantity and quality of capital that banks will be expected to hold. Importantly, the proposed rules also strengthen the capital requirements for counterparty credit exposures arising from banks' derivatives, repo, and securities financing transactions. I think the inclusion of a countercyclical buffer may also prove very helpful in providing a macroprudential tool that may prove useful in leaning against excessive credit growth that could threaten financial stability. As Governor Tarullo and many others have emphasized, capital isn't the only critical element of a strong regulatory regime, but it is certainly a key requirement. And I think it's very important that this rulemaking is taking place in the context of an internationally agreed set of standards to create a global playing field.
Thank you. Governor Duke.
Thank you. I also support the issuance of these notices of proposed rulemaking and the finalization of the market risk rule. I believe that strengthening the capital requirements, including the addition of a common equity requirement, is an important element of a more stable, resilient financial system. I view the capital conservation buffer with its graduated limits on capital payouts as a prudent safeguard for banks approaching regulatory minimums. I've thought a lot about the inclusion of unrealized gains and losses on securities, that is the other comprehensive income, in the capital requirement, and I'm in favor of including it. With interest rates at historic lows and loan demand weak, I worry that banks will begin to take on more interest rate risk to improve earnings, and as rates return to normal, longer maturity securities will decline in value, and this decline will represent a very real reduction in banks' ability to absorb losses. Including unrealized gains and losses will have the effect of incorporating interest rate risk on instruments that otherwise would have zero or low rates for credit risk. And I support higher risk weights for construction and land development lending. I would, in fact, include 1 to 4 family residential construction loans in this category. Construction and development lending resulted in especially high loss rates and led to the majority of bank failures in both the most recent financial crisis and in the savings and loan crisis. I am, however, less sure about the appropriateness of using specific mortgage underwriting characteristics to differentiate among mortgage loans for risk weighting purposes. Given the magnitude of the financial crisis and the role of mortgage loans in that crisis, I can certainly understand the concern about risk weighting for mortgage loans. And the risk weights in the proposal are well supported by loss data from the past several years, but this approach may not come without cost. We do not have any similar methodology in other loan types, such as credit cards or C&I lending. So as we parse the risk in mortgages more finely, we run the risk of distorting banks' willingness to make certain loans, and even, it seems to me, potentially creating some counterintuitive results. For example, an unsecured loan to a small business would have a risk weight of 100%, while the same loan, if secured by a second lien on the owner's residence with a loan-to-value of 85%, would have a risk weight of 150%. In another odd twist, a 95% loan-to-value HELOC would have twice the risk weight of a 1 to 4 family residential construction loan. So I'll be interested in reviewing any alternative suggestions for risk-weighting mortgages. Along the same lines, I look forward to receiving comments about the potential effect of the risk-weighting scheme on mortgage lending, consumer lending, and small business lending. I want to be sure that banks can still underwrite responsibly and meet the credit needs of their customers. Balance sheet lending might be the last alternative for sound mortgage loans that do not fit standardized underwriting boxes. I'm afraid that the narrower we make the boxes through regulatory action, the more important it will be to have an outlet for loan-by-loan underwriting that takes advantage of bankers' knowledge of their customers' experiences and circumstances. Also concerned that we could make it more difficult or expensive to tap home equity for home improvement, educational expenses, major purchases, or investments in small businesses. If this happens, it might have the effect of either discouraging such purchases or investments, or it might make investment in a home less liquid and thus more risky and less desirable for households. I also look forward to comments on this potential outcome of the proposal. And I believe it's important to weigh the precision of our risk definitions against the complexity of the overall regulatory structure. The qualifications for mortgages that receive lower risk weights are defined along a number of dimensions, including the loan-to-value, the structure of the loan, the priority of the lien, and the borrower's ability to repay. These are the same elements that will be used in definitions of qualified mortgages, QM, or qualified residential mortgages, QRM, in other regulations that govern mortgage lending specifically. We should think about the difficulty of maintaining consistency across numerous rules that are the responsibility of different agencies. If the elements result in capital requirements that don't line up well with the requirements of other regulatory mechanisms for restraining the risk in mortgage lending, it could further fracture and potentially restrict the mortgage market. So I'm interested in comments about the complexity of the mortgage risk definitions, the interaction and overlap with other rules, and the difficulty of collecting data to assign mortgage loans to different risk buckets, especially with respect to existing loans and purchase loans. Along the same lines, I'm interested in comments about any data elements required to calculate capital minimums and the cost or difficulty involved in locating or tracking them. Finally, even though the overwhelming majority of community banks already meet the common equity standards, and despite my strong support for high-quality, loss-absorbing capital, I'm still mindful of the cost and difficulty smaller banks face in accessing capital markets. I understand the problems that were revealed with respect to trust-preferred securities, but I also know that they were an important source of capital, especially pooled capital, for smaller banks. So I'd be very interested to hear about alternative forms of capital or structures that would meet the qualification criteria described in the rule, and thus could be more loss absorbing than trust preferred, but also more accessible than common equity for smaller banks. In particular, I'd be interested in other forms of capital that could enhance the strength of institutions that face self-imposed limitations on their common stockholders, such as sub-S banks, banks trying to remain below SEC registration thresholds, and minority banks. I commend Annalee and her colleagues, as well as Governor Tarullo, for the difficult but thorough job in considering these many difficult issues, and I look forward to receiving comments on this proposal.
Thank you. Governor Tarullo.
Thank you, Mr. Chairman. For the reasons I stated at the beginning of the meeting, I'm for all of these packages, conditional only on Annalee's agreement to take tomorrow off.
Thank you. Governor Raskin.
Thank you, Mr. Chairman. I too support moving forward with the three proposed rulemakings and finalizing the market-based rule.
Governor Stein.
Thank you very much, Mr. Chairman. I also support both the proposal to put out the 3 NPRs for comment as well as to finalize the market risk rule. I just want to add my congratulations both to Governor Tarullo and to the staff. I think it's worth stepping back and just sort of recognizing the accomplishment here. You know, there's always more to do on financial reform. There's a lot of important stuff left to be done, but on the simplest metric we have, which is common equity capital, we're moving from a world where 2% was the norm to a world where 7% is the norm. And that alone is, I think, one of the most important steps we can take to safeguard the financial system. I want to emphasize again this quality point, that is to say, the fact that it's common stock is a very, very powerful tool. People have used repeatedly the idea of loss absorption. And I agree with that, but I think that in some sense understates the importance. To me, the most important thing about common stock is what you might call its dynamic properties, the fact that it makes it easier to recapitalize once the bad thing has happened, because you don't have a very small sliver of common equity sitting behind an overhang of preferred, which would make things difficult. And this embodies what I actually consider to be one of the most central macroprudential principles, which is, of course, you know, protecting the taxpayer is paramount, and that's one of the goals. But as Governor Tarullo alluded to, it's not the only goal. One of the very important things we want to have is a financial system that, once a loss has been realized, is able to recapitalize itself and doesn't contract lending, but is able to sustain lending. And I think this thing is highly complementary. The use of common stock is highly complementary to efforts at prompt corrective action. And again, there's a lot of detail, but this one central feature, I think, is again, a very, very major accomplishment.
Thank you. Governor Powell.
Thank you, Mr. Chairman. As for the 3 Basel proposals, first, I think they send a strong message that the United States will live up to its obligations to implement international capital standards, and that's obviously a positive. Secondly, we saw in the crisis a need for both substantial improvement in both the quality and the quality of capital in our banks, and I think the proposed rules accomplish that in a way that is faithful to the Basel agreements and also to Dodd-Frank. The rules will make for a stronger and more resilient banking system, and I strongly support them. I also think that these are complex matters, and I know that all the responsible agencies will look forward to receiving comments and carefully consider them, and in the end, implement our obligations under Basel and Dodd-Frank in a way that is faithful to those rules, but that minimizes burden and economic costs to the institutions, and far more important, to their customers, who ultimately bear much of the burden. As far as the market risk rule is concerned, we saw in the crisis that the existing capital regime was inadequate to deal with the reality of the capital trading exposures. We needed a much better match between capital standards and the risks, and also a focus on assuring that the market risk rules were really only applying to trading risks and not what really should be credit risks. I think that the proposed rule accomplishes that, and I would add that I think the drafters were very thoughtfully responsive to the comments, and appropriately so, so I strongly support the final rule as well.
Thank you. I support the components as well. I think it's a very attractive package. It meets the standard of providing more and better capital, which is the most essential element. It's appealing to have an integrated framework that puts together everything in a consistent package, so that we don't have legacy rules that are damaging the logic of the framework. Appropriately, it focuses on the largest and most complex banks. That's important both because they are the ones who are the most complex and pose the greatest risks to financial stability, but also because they're best able to bear the regulatory costs and burdens associated with the rules. The macroprudential aspect, I think, deserves considerable note. The entire philosophy of supervision here at the Federal Reserve has been changed so that we now routinely consider macroprudential aspects of our rules and our supervision, and this package certainly does that. And as Governor Powell noted, this is consistent with the global agreements that were made. In fact, I think this may well be the standard against which other capital regimes around the world may be measured going forward, and I hope that other countries, other jurisdictions will meet this standard. As Governor Duke said, the devil is in the details here. There's many specific questions about appropriate weights, about regulatory costs, and so on, and that's what the comment period is for. And we will certainly take very seriously the comments we receive and other input that we receive, and try to make this product even better after the comment period is closed. But again, I do support this, and I thank the staff and Governor Tarullo, as well as Governor Duke, who's also on this committee, Governor Raskin, who's worked frequently with the supervisory efforts, and of course the staff. So with that, we have two votes. The first one will be to approve the three proposed rules, regulatory capital proposals, to be put out for comment. And may I have a motion, please?
So moved.
Second? All right. All in favor of approving the proposed rules?
Aye. Aye.
Any opposed? Thank you. The second vote is on the finalization of the market risk capital rule.
So moved.
Second. All in favor?
Aye.
Any opposed? All right. The two motions have carried. Again, I thank everyone very much. I thank our guests, and the meeting is adjourned. Thank you. Congratulations.